the best means of securing your wealth because it is real money, and that is gold and silver.
Gold adjusted for real inflation. This is the way that inflation was calculated by the US government in the 1970s. Then, if you adjusted for that, the gold price of 1980, which was 850 at the high in 1980, that gold price today would be $38,000. $38,000. And that is actually not a target, as I said earlier on. That is just coming back to the inflation adjusted level as it was in 1980. And in this coming era now,
I think gold got overbought, particularly in the retail market. It was due for a correction. We may see a little bit more of a correction, but nothing of any big consequence. But the direction for gold is definitely up, because what gold is signifying, the collapse of the Western world monetary system.
Global markets are entering a period of rising uncertainty as debt pressures, geopolitical tension, and inflation risks begin to collide. Both Simon Hunt and Egon von Greyerz argue that the current system is showing visible cracks, with war and financial stress acting as catalysts rather than the root cause. Their broader message is that the world may be moving into a far more unstable economic era where confidence in paper assets weakens and hard assets regain importance. Simon Hunt, a veteran macro analyst, and Egon von Greyerz, a longtime wealth preservation advocate, explained that energy shocks, weakening growth, and expanding debt burdens could create stagflation across many economies. They believe gold and silver remain among the strongest forms of protection because they carry no counterparty risk. Egon notes that if gold were adjusted to past inflation peaks, extreme upside levels could eventually be possible, though he frames that as a reference point rather than a direct forecast. Both speakers suggest temporary pullbacks may happen, but the long-term trend for precious metals remains higher. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Iran is not going to succumb to the threats that Washington is imposing on the country. From America's point of view, defeating Iran is not just to help its ally Israel, it's also to take control over Iran's energy resources, and by so doing, they will have the whole of the Gulf states in the palm of their hands. And the third item, is that defeating Iran basically will dismantle the BRICS group of nations, because Iran is a crucial logistical hub for the Deep South. So those are the reasons why I think that ceasefire beyond April the 20th and a deal with Iran is far removed from reality. The war ends in a couple of weeks' time. The global economy has been completely destabilized. It's not just the prices of oil. It's the prices of all the derivatives of oil, which have risen, in some cases, a multiple of what's happened to oil prices. And it's those prices, whether they be diesel, gasoline, helium, sulfur, urea, etc. Those are the prices that really matter, because those are the products that hit manufacturing and hit households. So at best, we are going to see probably across the world by the middle of the year or the third quarter, we're going to see stagflation and the probability in large parts of the world recession. It's not as though this oil shock occurred when you had an upbeat global and US economy. You had deep weaknesses, debt markets, the credit markets, inflation had already started to rise. And you put them all together with a massive oil shock coming on. When you look at what's really going on in economic activity, a recession is almost inevitable. China has been preparing for a breakdown of relations with America for several years. They have built up and continue to build up a massive oil and gas reserve. What people don't seem to appreciate is that whatever shortfall, I should also add that in the last couple of years, they've been drilling very deep sea oil wells, and their production has been rising. At the same time, consumption has been flattening out, particularly on the transport side with EVs, and they've been positioning themselves well with solar energy. Any shortfall that China will have from whatever happens in the Middle East will be balanced by increased imports of oil and LNG from Russia. So America obviously has got China in their sights to at the least contain China's growth and at worst to cause big economic problems within the country. But they won't do it through energy because they've already built their contingency plans. The same applies to some metal sectors and food also. Their exports have shifted away from America and to some extent from the EU into the Deep South and Asian markets and African markets. The GDP numbers for the first quarter, 5%. I don't think that's going to persist throughout the whole year. I think we'll probably come in a shade below last year. But all the preparations have been made to prevent social instability whilst the external environment is very risk-on. The best means of securing your wealth, because it is real money, and that is gold and silver.
The deeper concern raised is that the global economy may already be too fragile to absorb another major shock. Hunt explains that higher oil and derivative costs do not just affect fuel, they move through fertilizer, transport, manufacturing, and household expenses. That creates the risk of recession arriving alongside inflation, a difficult combination for policymakers to solve. He also points out that some nations have spent years preparing for trade fractures by building energy reserves, diversifying exports, and securing supply chains. That means future economic competition may be less about growth and more about resilience. In such an environment, capital could continue rotating away from debt-heavy financial assets and toward commodities, energy, and monetary metals. Let's get back to the interview.
The coming years will probably be the most difficult that the world has ever experienced. It will affect the world both politically, geopolitically, as well as financially. The war that we're seeing now between the US, Iran, and Israel is not really the cause of the problems that we will see in the world. It's just a catalyst, and there'll be lots of catalysts coming in the next few years. Before that, let's just say that gold will reflect all the problems that are coming. A potential target could be $38,000. It's not a forecast, but I will talk about later in this video how we get to that. Now, look at first what happens to inflation and interest rates at the end of a monetary era that we are in right now. Interest rates have gone from 16%, that's measured on the 10-year US Treasury bond. In 1980, there was 16%, and it was down to 0.5% in 2020. Now we're just over 4%. My forecast, as this graph shows, is that we are going to go above the 16% in the 1980s. I think we could overshoot it by a big margin for the simple reason that inflation will be higher than it was in the 1970s, and there'll be many more defaults than we saw in the 1970s. And I would expect in this coming era that we also see sovereign defaults. The US will definitely default in one way or another. Doesn't mean that they go bankrupt, but it means that the currency will go to zero and the money printing will be unlimited. So that virtually will lead to US Treasury bonds being worthless, and therefore interest rates could even go a lot higher than the 16 to 20% that we saw in the 1970s. It could go a lot higher even. Now, of course, people will suffer dramatically with these high interest rates. I saw just a recent article, fishermen in the North Sea. It used to cost them £5,000 to go out with their boat to fish haddock, and now it's up to £10,000. It's doubled in a very short period of time. That means higher prices for consumers, lower income for the fishermen, and losses within the system. And that's just one example. It will happen throughout the system. There'll be massive inflation and there will be misery because people cannot afford the higher prices, and all governments can do is just to print more money and make the currency more worthless than it is now. And it's, as we know, and I talked about many times, already gone down by 99% since 1971. That is against gold, dollar, euro, yen, etc. And they've all gone down 99%, and it's only 1% left. So this will just not have consequences for markets, bond markets. That will, as I said, crash, but also for stock markets. Stock markets are now starting a major downtrend. Before this is over, I see the Dow Jones and the Standard & Poor's go down by 90 to 95% against gold. And gold is really only measuring in real terms. So if you look at the graph here, it shows how we've already gone down 75% since 1999. That is, stocks or the S&P has gone down 99% versus gold since 99. Now, from this level, I expect another fall of 95% before this era is over. And that fall could happen very quickly. It could take a few years. And then after that, it goes along the bottom, maybe for 5, 10 years or longer. So this is a massive shift from paper assets to real assets. And anyone who gets caught with the paper assets and does not shift into real asset is going to lose all their wealth in coming years. I repeat, you are going to lose all your wealth if you don't shift to real assets. And that is not a joke. That is absolute reality. And please don't wait for the market to recover before you sell. Sell now. Sell before it reaches the low levels. You can never sell at the top. Now is a good time to sell. Now is a good time to switch to gold. Remember, so gold is going to go up substantially, but that is measured in dollars or in euros or in yen. But actually in real terms, gold is not going up. It's never gone up. Gold maintains stable purchasing power. I looked at the ratio between a cow and gold. You know, since we can't measure gold in money terms because money goes down in value by the day, why not measure it in something real that everybody consumes? That is, for example, a cow. And over the last 5,000 years, a cow in gold terms has cost between around half an ounce of gold to just over 1 ounce of gold. That is quite remarkable. Think about that. Cow has not gone up by more than half an ounce of gold maximum over a 5,000 year period. It shows you that when you look at your wealth in paper money, it's absolutely the wrong measure to use. Think about instead money in real terms. Think about money in gold terms. That's the only way to measure your wealth. So what is the consequence of this? Of course, the consequences are dire. It'll be collapse of the financial system. It'll be a collapse of the many banks, maybe the majority of the banking system. It'll be restructured at a massive cost. There'll be collapse of the bond market and, of course, of the stock market, as I said, and times will be very tough. So in money terms, which, as I said, is not the way you should measure gold. You should just take gold as stable purchasing power. But if you want to look at it in money terms, because you should, because if you keep your money in currencies, in dollars, in sterling, pounds, or in yen, then you're going to lose all of your wealth. But if we measure it in real terms and adjust it for inflation, gold adjusted for real inflation, this is the way that inflation was calculated by the US government in the 1970s. Then, if you adjust it for that, the gold price of 1980, which was 850 at the high in 1980, that gold price today would be $38,000. $38,000. And that is actually not a target, as I said earlier on. That is just coming back to the inflation-adjusted level as it was in 1980. And in this coming era now, it could happen very quickly or it could take a few years. We will see at least that price in paper money and probably a lot more because, as I said, there'll be massive amounts of paper printed. So please buy gold, buy physical gold, store it in a safe place, in a safe jurisdiction outside the banking system. Also buy some silver. Silver is now massively undervalued and is likely to go up a lot faster than gold for quite a time.
What makes this conversation important is that both speakers are describing a structural shift rather than a short-term crisis. They see decades of debt expansion, currency debasement, and geopolitical overreach reaching a breaking point. If that view proves correct, markets may become more volatile, central banks may lose flexibility, and purchasing power could keep eroding even if headline data temporarily improves. For investors, that means traditional assumptions may need to change. Safety may no longer be found in paper promises alone. Real assets, liquidity, and diversification could become increasingly valuable. Gold may continue acting as a barometer of monetary stress, while silver could benefit from both monetary demand and industrial demand if supply tightens. Temporary corrections may shake confidence, but they could also become accumulation opportunities in a larger bull cycle. The biggest takeaway is simple. When systems become unstable, preserving wealth can matter more than chasing returns. Simon Hunt and Egon von Greyerz are warning that the next few years may test governments, markets, and households alike. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.